This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The Fed's done. Rates are coming down. The stock market's broadening out. Smooth sailing, right? Well, not so fast. As a famous trader once said, the stock market is never obvious. It is designed to fool most of the people most of the time. After a stellar finish to 2023, so far this year, the trends are as mixed and muddied as ever with very little follow-through. Let's try and make some sense of it all. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton. I guess it's not too late to say Happy New Year. I think I can say that up until February 1st. But as mentioned, it's been a turbulent start to 2024. And by turbulent, not to say that we've had big downdrafts in stocks or bonds, but we've certainly seen very muddy, what I would call sloppy performance. And I just say in general, we're still on the roller coaster, aren't we? I don't know if it's just kind of the way the world is these days. We're in an era of polarization. We all know, of course, about political polarization, which will only get worse here with the election only 10 months away. But we're also in the midst of market polarization. Basically, 2023 was the polar opposite of 2022. I read some data from Charlie Bolello, the blogger I follow pretty religiously, that's incredibly poignant. Think about this. Last year, growth stocks outperformed value stocks by 31%. That's the second biggest outperformance on record, going back to 1979. 2022, they had underperformed value stocks by 21.6%. That was the most since 2000. How about the S&P equally weighted index? I've talked about that a lot. Remember, the S&P is a market cap weighted index. So the larger the company, the larger the influence. But there's an equally weighted S&P index that gives you a better feel for kind of how the average stock is going. Well, the market cap index outperformed the equally weighted index by 12% last year. Second biggest outperformance on record, going all the way back to 1971. In 22, the equal weighted index had outperformed by 7%, the most since 2010. How about U.S. stocks versus international stocks? S&P outperformed international stocks by almost 8% last year after underperforming by 4% in 22. The three best sectors in 22, energy, utilities, consumer staples, were the bottom three in 23. While the bottom three sectors in 22, tech, communication services, and consumer discretionary, were the top three in last year in 23. How about bonds? After suffering the worst year in 2002 in history, bonds actually finished with a positive return in the mid-single digits last year. I'm not going to belabor the point. The fact is, we've had extreme swings in both directions. So maybe we should expect more of the same this year. I hope not, but that's been the 2-year track record. And maybe it's no accident that if you look at the S&P 500 forecast for this year, from the major kind of Wall Street firms and major asset managers, they're all over the place. I read just the other day, again, this is from Charlie Bolello. I want to credit him for those stats that I've used so far. If you look at the major Wall Street investment firms, Yardeni Research is one that I followed. He still has about a 13% upside target for the S&P for this year from this point forward. JP Morgan is down at minus 12% from this point forward for 2024. That's a pretty big swing. Remember, coming into last year, coming into 23, it was almost unanimous that the markets weren't going to do well, which of course turned out to be wrong. This year, you seem to have a much wider range of expectations. But I think it's really important, given this type of environment that we've had the last couple years, that we all take a step back and keep some perspective. Because if you look at longer-term S&P 500 returns, it's amazing how consistent they've been. So according to FactSet, I looked at the S&P 500 annual returns through the end of last year. Over the prior 5 years, so what is that, 2019, I guess, through 2023, the S&P averaged 15.5% a year. Think about that. Through COVID, Ukraine, Hamas, The Fed raising rates from 0% to 5%. Inflation going from 3 or 4% to 9%, back down to 3-some percent. All these things, of course, an election, the first Biden-Trump election, all these things that we've had to contend with, S&P averaged 15.5 a year. Over the last 10 years, through the end of 2023, it's been 11.9% a year. 15 years, 13.8. 20 years, 9.6. I think the only reason that's a little bit lower is because you're factoring in that kind of post-dot-com bubble period where it took a while for the market to get going. And what's amazing is if you go out further, the returns are almost identical from decade to decade. 30 years, 10.1. 40 years, 11.2. 50 years, 11.1. 60 years, 10.2. The point is, when you consider how many crazy things, for lack of a better word, that have happened over the past 5-6 decades, wars, terrorist events, inflation cycles, different interest rate environments, different, Democrats versus Republicans, liberal versus conservative, all these things that we've had to contend with, the S&P basically stacks up the same kind of numbers on a long-term basis. Now, that's no guarantee about the future, of course. This could change. Maybe we have lower returns in the future than we have had historically. That's always a possibility. But I think it's a really good lesson that as much as we get caught up in the day-to-day, week-to-week, month-to-month news flow, a lot of this stuff ends up not mattering anywhere near as much as you think over a long period of time. So where does this leave us now? Let's kind of flash forward to the present here. Well, the end of last year was pretty unbelievable. Again, we've been talking about polarizations, polar extremes, huge swings, roller coaster swings. Well, we saw at the end of last year too. Remember, the S&P basically corrected, I think, almost 12% from the end of July through, I guess, early to late October, early November. If you look at the last 2 months of last year, the S&P went back up 13.9%. That's in the 99th percentile of all 2-month observations, any back-to-back months, since 1928, according to Charlie Bolello. Bond market up 8.5%, also in the 99th percentile of all observations. 60-40 blend of stocks and bonds up 11.9%. Last 2 months of the year. That's the 2 best months since March, April of 2009, which of course was kind of the escape from the financial crisis, and the 5th best since 1976. So it's not surprising as we come here into 2024 that there's a little bit of pause, right? And we'll talk more about this in a couple minutes, but I think we've all come into 2024 in many ways, literally and figuratively, a little fat and happy, right? Stocks and bonds basically went straight up. But if you look at the history of it, the kind of muddied, sloppy performance we've had so far this year is nothing at all that should surprise us, regardless of what any fundamental backdrop or what the actual reasoning is, because just volatility is inherent. I've quoted these statistics before from Ryan Dietrich over at the Carson Group. He looked at the markets, the S&P from 1928 through the end of last year, and found out that on average, the S&P sees at least 7 separate dips of at least 3% a year, 3 separate pullbacks of 5% a year, and 1 correction of at least 10% a year. On average. And of course, some years have been a lot more than that. His advice is to print this off and pin it to your desk. And I would advise you to do the same because, again, the volatility we've seen so far this year is nothing. I would also say, and I said this a couple weeks ago, but I think it bears mentioning again, just because we had a good year last year overall at sort of the broad index level, as I mentioned, punctuated by a very strong November and December, does not necessarily mean that, what goes up has to come down, that we have to sort of give back or we have to mean revert or anything like that. In fact, history would suggest the opposite. The good years, for the most part, are followed by good years. Sam Stovall over at CFRA, he went back to 1946 and found that the S&P has posted a positive annual price return about 71% of the time, which is consistent with what I've quoted on the show for years that the market generally goes up about 3/4 of the time, okay? But what he also found out was that each of these positive performances was then followed by an average increase of 6.9% with a frequency rate of about 70%. But this is the kicker. After an annual surge of 20% or more, the S&P 500 rose an average of 10% in the following year and advanced 80% of the time. Good years tend to follow great years with above average frequency. Again, is this any guarantee of the future? Of course not. Of course not. But there's certainly not a statistical backing for saying that after a good year it means we're inevitably going to have a bad year. Okay, there's no historical or statistical precedent for that. I mentioned how we've sort of come into this year a little bit fat and happy. It was the total opposite, remember, coming into 2023. Coming into 23, the market had just come off a 20% down year in the S&P and a mid to high teens negative performance for bonds as well. It was as negative a period of time that I can recall since maybe the trough of the financial crisis. You had the longest streak of negativity in retail investor sentiment we've ever seen. This is according to FactSet data. The most persistently negative consumer in history, if you measure sentiment. And as I mentioned a minute ago, Wall Street consensus was uniformly negative. This time around, coming into this year, I would say it's kind of been the opposite. I don't think the sentiment is unanimously positive or was unanimously positive, a few weeks ago, but it was pretty darn ebullient. I think the perception was that the Fed is done, that rates are coming down, inflation's under control, we're going to have this proverbial soft landing where the economy doesn't go into recession. But as I quoted at the top, the famous trader Jesse Lauriston Livermore once said, I'll quote it again, "The stock market is never obvious. It is designed to fool most of the people most of the time." Doesn't mean you have to be eternally, contrary to what's going on, contrarian, I should say. You don't have to be eternally betting against the market. That's not what I mean. But it just seems when everybody sort of believes something's going to happen, when the sentiment gets tipped too far in one direction, either too optimistic or too pessimistic, it's quite often a catalyst for things going the other way. As Ed Yardini wrote just about a week ago, roller coaster rides are unnerving on the way up and then thrilling on the way down. Stocks are the total opposite. They're thrilling on the way up, unnerving on the way down. And that's, I think, kind of what's going on so far this year. People are kind of doubting themselves, doubting what's going on after 9 straight weeks of gains to close the year. And part of it's coming from the Fed, too. Fed Governor, I think it was Christopher Waller, I believe. He's one of the more hawkish Fed governors. He gave a speech about a week ago, maybe a week and a half ago at the Brookings Institution, where he kind of sounded upbeat about the economy, which you would think would be a good thing, right? Talks about how unemployment is still under 4%, inflation's been coming down. But then he said, and this was the quote that people kind of latched onto, quote, "I see no reason to move as quickly or cut as rapidly as in the past." And I think that's kind of been the wet blanket on the market so far, that when we got that really cool inflation figure in October, I guess it was early November, it was the October reading, people took it to mean that the Fed was done, which I still think is the case, but also took it to mean that the Fed would be cutting rates as soon as March. And recent commentary has really pushed back against that. And quite frankly, recent data has pushed against that. If you look at December retail sales figures, some of this data is not reflective of an economy where you need to really stimulate it through rate cuts. So again, I'm just kind of talking about how things do not play out one directionally. I said for the last several months, I expect this to be a bumpy ride. And we haven't even talked about the other stuff, right? We haven't talked about politics. We haven't talked about geopolitics. We haven't talked about a number of issues that could cause volatility this year. But just in general, I expect a bumpy ride. And of course, we'll find out a lot more here in the next few weeks because we're getting fourth quarter earnings. I will say expectations for this year in general are fairly optimistic. If you look at consensus earnings forecast for 2024. It's around 11.4% at this point. I do expect that revision to come down, or to be revised lower, I should say. But I still think, we had the potential to have a decent earnings year. I mean, if you recall last year, and I talked about this a lot, corporate profit margins held up a lot better than people thought. People thought with higher labor costs, with higher interest rates, of course, that corporate profit margins would really come under pressure. Really didn't happen. Whether it was the harnessing of artificial intelligence, whether it was just getting more efficient coming out of COVID, with less real estate footprint, less corporate travel, whatever it is, companies were able to be much more efficient on the bottom line. And I'm very interested to see here, and we'll learn more in the next few weeks as we get, all these earnings reports, very interested to see what the trends look like for this year. Because if corporate America can stay efficient and come anywhere close to maintaining the profit margins we had in 2023, things could go a lot better than people think, because there's a lot of operating leverage. When you cut costs, that gives you much more leverage to any pickup in revenues. Okay, and it just means you're much more efficient with each incremental dollar sold, right? So again, there's still risks out there, of course. Things tend to work with a lag factor when it comes to interest rate hikes, right? So it's still not out of the question that we get a material slowdown in the economy later this year. But any sort of improvement will flow through to the bottom line pretty quickly. And I mention all this because what was also interesting about last year is that valuations actually expanded. That was not a base case of anyone coming into 2023. The market got more expensive. Now, a lot of that came from the Magnificent Seven, right? That collection of mega cap tech stocks at the top. But still, the overall S&P 500 multiple expanded over the course of the year. But here's what's interesting. I don't think the average stock is that expensive. So if you look at the S&P 500 as a whole, according to FactSet, trading roughly 19.5 times next 12-month estimates. And again, the market will look a little bit more expensive if those estimates have to be revised lower, right? But as it stands, about 19.5 times estimates. If you look at the equal weight consensus, which remember is assigning all 500 companies an equal weighting, we're down to less than 16 times next year's earnings. In particular, we've talked a lot about how dividend-paying stocks, a lot of the bluest of the blue chip stocks, the consistent dividend payers, how much they underperformed last year. If you look at the S&P 500 Dividend Aristocrats Index, which I followed for some time, had an okay year, was up about 8%, but underperformed the headline S&P 500 index by the most since the height of the dot-com bubble in 1999. So what's that, 24 years ago. And keep in mind just side note, after that period, after 1999, that Dividend Aristocrats Index actually outperformed the S&P by like 54% over the next 3 years. So hopefully it's a repeat performance. But I mention all this because if you look at the valuations, the Magnificent Seven trading roughly 33 times this year's earnings, or expected earnings this year in aggregate. You look at companies on the S&P with dividend yields greater than 2%, trading at 14.6 times earnings, which is pretty darn reasonable, and pretty reasonable, especially reasonable if inflation stays contained and if, in fact, interest rates come down at some point. Again, the source there is FactSet. So I'm very interested to see what happens here in the next few weeks, what type of guidance we hear about profit margins specifically, and how much confidence companies have in their earnings outlook, which, of course, would add up to that in aggregate 11% forecast. The other thing that I'm focusing on is some sort of interesting sector trends. And again, we'll have more specifics for you in the coming weeks. But, if you look at technology, for example, according to Strategas, tech stocks in general, 86% of the tech sector is trading above its 200-day average, which is in the top decile of all readings going back like 30 years. And this is a sector that's expected to have peak earnings. The best earnings for the year will be the first quarter earnings, according to FactSet. So I'm a little bit nervous there. On the flip side, healthcare is very interesting. Now, I know we're only 3 weeks into the year, but so far healthcare, with a few exceptions, has performed a lot better, despite the fact that their rolling 5-year relative performance, in other words, performance relative to the S&P, is at the lowest level, well, at least in the last decade. And I think it sits in the bottom decile of all readings going back about 50 years. What's more, you've seen record levels of outflows from the healthcare sector. Remember, healthcare was one of the worst performing sectors last year. So here you have a sector that is one of the biggest weights in the S&P that you could probably argue pretty credibly is somewhat washed out. So again, I know I'm being a little bit general, but and a lot of that's because we're only a few weeks into the year. But those are some of the things that we're looking at. We'll have a lot more information for you as we move through this fourth quarter earnings reporting season. Let me transition a little bit. I talked a few minutes ago about sort of the polarization of performance. I don't know if that's the right way to put it, but you've had these polar extremes. And so, because of that, it really, I think, lends people to question the merits of diversification. When you have one area, last year it happened to be large cap tech, doing so well, why bother with spreading out your risk? Because in many years, diversification only serves as to lower your returns, right? You're diversifying into things, and people even call it de-worsification. The more you diversify, the worse your returns are. But I would just caution you. Obviously, I always say don't invest by looking in the rearview mirror, but also be very wary of recency bias. A good example of that is looking at U.S. stocks versus international stocks. So according to Nick Majuli, a financial blogger I've quoted a lot on this show, he looked at international stocks versus the S&P, and he went back to 1970 through the end of last year. Found that U.S. stocks outperformed international stocks in 54% of all rolling 10-year periods and 80% of all rolling 20-year periods. Pretty darn good, right? U.S. stocks are obviously the place to be. But then he went back a little bit further, and what he did was he actually stripped out the last 10 years, which I thought was very interesting because the last 10 years have been almost all U.S. Few exceptions. 22 international did a little better than the U.S. So there have been a couple exceptions along the way, but for the most part, it's been all U.S. the last decade. So he looked at the same data, except he went from 1970 through 2013. And guess what? Stocks would have only outperformed international stocks in 41% of all 10-year periods. And in fact, the only time where U.S. had sustained outperformance was the lead up to the tech bubble, which of course ended in spectacularly bad fashion for U.S. stocks. So, that's just one asset class, international versus the U.S. But I think the point is be careful thinking that what has been in place for the last 5 or 10 years will be permanently in place. You could say the same thing with respect to stocks and bonds, right? I think when a lot of people think about diversification, they think about negative correlation. They want something that goes up when everything else goes down. But with respect to stocks, you've got to kind of check that attitude. And I say that because, as I said earlier in this podcast, stocks have been up about 3/4 of the time, over 70% of the time, going back to 1928, at least U.S. stocks. So you don't really want something that goes down when stocks go up. That would just be a huge drain on your long-term performance, right? What I think you want is an asset that has a low positive or negative correlation to stocks, with the understanding that the correlation is going to change over time. Ben Carlson up at Ritzold Asset Management, he did some really good work on that this week that I thought was very interesting. He looked at the stock and bond correlation this century, so going back to 2000, 23 years. It was in negative territory for the majority of the century, meaning that stocks and bonds moved in different directions, until recently, where you've had much more positive correlation. Obviously, last year, stocks and bonds went up together. In 2022, bonds failed as a risk hedge because bonds went down almost as much as stocks did. But he went out further. He went back to 1926, And what he found was stocks and bonds have been positively correlated about 60% of the time, negatively correlated about 40% of the time. So what he's saying is that it's perfectly normal historically for those two assets to move in the same direction at the same time. 22 was kind of an outlier from that sense. Most of the time, bonds are a good hedge. He looked at the worst years ever for stocks going back to 1926. The average loss for the stock market in a down year is about 13%. In those same years, the average 5-year Treasury return was about 5%. So on average, bonds have served as a pretty good risk hedge for stocks. It's just that nothing works all the time. And there are times when a positive correlation helped you, like the 80s and 90s where stocks and bonds were doing well at the same time. There are times when a negative correlation helped you, like the 2000s. Remember the lost decade for stocks, right? 2000 through 2010, where stocks basically had zero return, but bonds averaged over 7% a year. So I think the point is sometimes diversification doesn't work. Sometimes you're better off having all your money in one sector, one asset class. But it tends to not be a repeatable process. And quite frankly, for our more mature clients, I should say, our retired clients who have maybe a shorter time horizon, diversification is even more important, right? Because you don't want to go through a 5, 10, 15-year period where the asset class that you've selected to dominate your portfolio, underperforms. Okay? So keep that in mind. I'm not going to belabor the point on that. I just had a few quick comments on the economy, and I always hesitate to talk too much about the economy because, as I've said for years, just because you get the economy right, which is a big if, by the way, most people get the economy wrong, as we saw last year. But even if you got it right, stock market cycles and economic cycles do not sync up on a one-for-one basis. You can have long lag factors between the economic influence and market influence. But it's still important to know that when we have a recession in this country, it generally leads to negative earnings and generally leads to bad markets. Now, the start and stop of recessions may not coincide with the start and stop of stock sell-offs directly, but there's still that historical correlation is pretty strong. So I think it is worth noting that I still think, and I've said this for months now, I still think the case for a significant economic drawdown in this country is fairly weak. Not to say it can't happen, not to say we won't have some degree of slowdown, but I just feel that the economy is better positioned than it was in advance of other recessions that I've been associated with over the past 30 years or so that I've been in the business. I mean, and there are a lot of ways to look at it. Certainly inflation is one of them. I know a lot of people still talk about inflation. I'd probably have a conversation every week about inflation with clients saying how much higher prices are today than they were. And that's the case. I mean, that'll continue to be the case. Unless we get outright deflation, dropping prices, which, by the way, has only happened a handful of times in U.S. history. It's a very rare event. Prices are going to be much higher than they were 4 or 5 years ago. But the rate of change, the rate of increase is definitely slowing. We saw the December inflation data that core inflation was down to 3.9%. Headline inflation, which includes food and energy, was down to 3.4%. That's down from 9%, year and a half ago, right? So that's pretty good. It did miss expectations, though. Inflation was a little hotter than what people thought, which is one of the reasons why you've seen interest rates go back up a bit, and a reason why the market is not as convinced that we're going to get rate cuts anytime soon. But the thing about that inflation figure is half of it came from shelter, housing prices and rent prices. And what's particularly interesting about that is rental prices in this particular inflation reading were shown to be still increasing. That's really an anomaly of the way that the CPI, the official data, calculates rent prices, okay? Because if you look at every other survey, and I follow a lot of this stuff, whether it's the Apartment List National Rent Report, whether it's nationwide, whether it's Zillow does a rent price calculation. Every one of them has shown rent prices coming down on a line over the last 6, 7, 8 months. So I think that the takeaway there is it will eventually show up in the official government data, but it works with a significant lag factor. I would guess by June or July that inflation is down under 3%. Just a guess, I'm not a soothsayer. I know there are other potential things that could cause inflation to be sticky, like some of this government spending that's coming from the Inflation Reduction Act, some of that infrastructure spending. But still, I think the trend will be lower and that consumers will feel better about prices than they did a year or two ago. The other thing I would just say is that household balance sheets are in much better shape than they were in advance of the past few recessions. In fact, according to Federal Reserve data, at the end of the year, household net worth in aggregate across the country as a share of disposable income was 740%. That's the highest level ever recorded, except for a brief period in 2022. And what's interesting is households in the lower half of the income distribution, who typically have about twice as much of their wealth in housing versus the public markets, also saw a meaningful increase in the net worth to income ratio, the best since 2019. So people talk about the average American not doing that great. Well, from a net worth perspective, they're doing better. They're doing better than they have in a long time. And then things like debt to income ratio, which is a good measure of kind of household stress, right? The ability to cover your bills, cover your debts. Not as low as it was a couple years ago, but well below historical norms, at least norms seen in the last 20 years. And yes, you're seeing credit card delinquencies pick up a bit, but they're not going back to new highs. They're just normalizing back to where they were before COVID. So it's really important to look out 5, 6, 7 years on this data because COVID was such a weird time, for lack of a better word, right? People sat on their wallets. People didn't spend a whole lot. People increased their savings. So household balance sheets were kind of disproportionately strong, if that's the right way to put it. So yes, we're seeing a bit of a worsening from those levels, but we're still looking very close to where we were 2017 through 2019. And here's the biggest, I think, reason to be positive. Real wages are growing. And by real wages, I mean wages versus inflation. And they're now above pre-pandemic levels. So, in fact, it's been, and again, this is according to Federal Reserve data, it's been 7 straight months of positive real wage growth following 25 negative months in a row. Okay, so that's a big sea change. When you see your income rising faster than prices, that is why, of all the data that's out there, I think that's the key thing. Now, can this all change? Of course. We start seeing a bunch of layoffs and wages start to drop because employers start to have more pricing power. Sure, a lot of this could reverse. But for now, we're just not seeing, or at least I'm not seeing, the type of stress that I saw, 2005 through 2007, for example. So all this bears watching, but I just want to give you a little bit of the backdrop as we start this year. Up next, stick with me. I just want to spend a few minutes giving you the latest on a few of our top holdings. As I mentioned, we're in the early stages of fourth quarter earnings reporting season. Back in a sec. Inflation is running hotter, and returns are cooling down. Is your financial plan primed for a changing environment? I'm Simon Hamilton with the Wise Investor Show. Every week, we discuss the latest financial trends and what investors need to know about them. To learn more about the impact of higher prices and how to become a better informed, wise investor, listen to the Wise Investor Show at thewiseinvestorgroup.com or find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Just had a few updates for you. We started to hear from companies and their fourth quarter earnings. Just a quick disclaimer before I get into this. When I start to talk about individual stocks, these are generally companies that we own in a number of our client portfolios. All the names I'm mentioning today are also names that I own personally, so you can decide whether you think that represents a conflict of interest or not. I'll also tell you that, if you're a client, I think you can be pretty confident that we've done our due diligence. We feel that we've made a prudent and suitable decision for your portfolio. But if you're not a client, you really have to do your own research. I can't manage through the podcast. You have to decide with your own research or your advisor whether it's appropriate for you. Just want to give you a couple updates, though. JP Morgan reported JPM beat significantly on the bottom line and the top line. I think what really stood out for me about JP Morgan is that they've generally been what I would call best in breed. And by best in breed, I mean consistently the most profitable large cap bank. Maybe not every quarter, but that's been their sort of their MO. And one way to measure that is by looking at ROTCE, which stands for Return on Tangible Common Equity. It's a real kind of profitability measure. Well, it came in at over 20% for the quarter. That was almost 1.25 percentage points better than Wall Street expectations and over about 3.5 percentage points better, 3.5%, versus the company's own guidance for this period. So they really did well there. They delivered much better net interest income, which is also a measure of banking profitability. And there were some warts in the quarter. They're certainly still seeing a slowdown on the sort of the M&A side, mergers and acquisitions side, trading activity, some of those business lines that are a little more volatile. But overall, it was a very solid execution. I think it's pretty clear that JP Morgan benefited, got stronger as some of the other banks failed, last spring, like Silicon Valley. They're not the cheapest stock in the world, but seem to be trading at a fairly reasonable valuation, trading at less than 11 times this year's earnings, which is historically pretty cheap for them. So there's certainly risks to the story. I think the biggest risks are sort of macroeconomic risks. If we go into recession, banks are going to fall. It's just pretty simple. I'm also very curious to see what kind of regulatory changes are coming as a result of the Silicon Valley collapse. Do the regulators require a lot more capital on hand, which would decrease, all else being equal, their profitability? So there are definitely risks to the story, but I think JP Morgan is a very high-quality bank, and any sort of sell-off in financials, that's one that we'll be keeping an eye on. Another bank that we actually added to our equity income portfolio for a number of clients where it was suitable is Truist, symbol TFC. You probably know Truist if you're in this area, the Virginia, sort of North Carolina area. They were formed as by the merger of Sun and BB&T a few years ago. And to be honest, it was a pretty messy merger. When that merger was announced, I remember the stock did not do particularly well. A lot of people were sort of questioning the synergies. And it's taken a long time for Truist to kind of get more efficient. Right-size the payroll, make sure there weren't as many overlapping job functions, really get more efficient. That appears to be taking hold. If you look at their most recent quarter, and the fact, by the way, that the new management team has a sharpened focus on franchise efficiency and bottom line productivity, it seems to be taking hold. That is showing up in the numbers at this point. Not to mention they pay a 5.7% dividend at this point based on this price. I'll also say they have some optionality there. There are a lot of analysts that would like to see them spin off their insurance business. There was a report from Bank of America Securities that thinks that they'll do that. That would allow them to unlock some capital, which could potentially go into debt reduction, potentially boosting the dividend further, share buybacks. So Bank of America really likes their balance sheet optionality, to use their words, pretty reasonable stock price, trading at about 11.5 times earnings. Pre-pandemic, they were at about 13 times earnings over the prior 5 years. That was according to Bank of America as well. So if you're looking for more of a yield play and you're okay kind of stomaching the volatility of the financial sector, you may want to take a look at Truist. I'll also say that the way their balance sheet is structured, that they actually have more sensitivity to falling interest rates than a lot of their peers. When I say sensitivity, positive sensitivity. They actually look better if rates come down than a lot of their peers from a balance sheet perspective. Again, the caveat there is that rates may not come down, right? Rates may stay elevated, and they'll have the same macro risks that JP Morgan has in terms of recession risk. By the way, that JP Morgan report that I was referencing was issued by Goldman Sachs. I want to give them credit. So Truist and JP Morgan are standing out for me on the banking side. I also wanted to mention a relatively new addition to our portfolio, which, we actually probably went to the buy side a couple weeks early, unfortunately, and that's United Health Group. Stock's down maybe 3 or 4% since we started adding to it, but still feel very good about the long-term positioning of United Health Group. I mean, I really feel they are a core holding, not only in the S&P 500, but in long-term growth portfolios. Symbol is UNH. Just to kind of refresh your memory on who they are, I mean, if you work for a company, there's a good chance that UNH runs your healthcare. They're the sort of incumbent leading insurer of scale across pretty much every business line within healthcare. Medicare, Medicaid, commercial markets. They have a large and growing presence in localized care, like physicians, urgent care, ambulatory care, a very fast-growing healthcare IT consulting business, and a significant pharmacy benefit management business. So they have the whole food chain, if you will. And I think that what they've proven is that they can manage that well. They can extract value all up and down that chain. It also gives them a lot of diversification of revenue streams and earning streams. So there are times where one business line is not doing so well, another business line is. Allows for, I would say, much more consistency. In fact, just to put that in perspective, according to a recent report from Raymond James, over the past 20 years, they have never posted negative sales growth. In 20 years, not 1 year. Not during the financial crisis, not during the COVID year. And they've seen 6% year-over-year increase in earnings, 19 of those 20 years. Think about that, especially when you consider all that's happened with healthcare. Obamacare came in. Obamacare was threatened. I mean, all kinds of things. The COVID year, right? And that is an unbelievable consistency. However, the reason the stock has been under pressure recently is I think their Medicare Advantage product, where they have about 28% market share. They're the market leader. There have been some pricing issues there. And, well, when I say pricing issues, basically what's happened is Medicare suffers when more people seek claims, when more people ask for services, right? So the combination of particularly seniors deferring treatments, deferring checkups, deferring procedures during COVID and now coming out and getting those done, plus with a hotter COVID and respiratory virus season than I think a lot of people modeled for, they had a big uptick in claims. And when I say they, it's really been the whole industry. Humana came out just on Thursday, kind of dropped a bomb on the market by really having a much worse loss ratio than what they had modeled for. But the difference, and this is not really about Humana, but I think what separates United Health is, despite that issue, United Health has been able to maintain their earnings estimates for next year and report double-digit growth both on the top line and the bottom line in the fourth quarter. So that just shows you the power of the diversification of their business. Obviously, the risk to the story is if this becomes kind of a permanent condition and they have to permanently model worse profit margins on that line of the business. That would have a pretty big impact on the future earnings trajectory. But for one, United Health doesn't think it's a permanent condition. Two, I would say that United Health is more of a price setter than a price taker because they're dominant position. Three, they're actually adding to that business. So a couple of their competitors disappointed in terms of new enrollees. United Health actually surprised to the upside. So, and the valuation, I think, is undemanding. Remember, United Health was basically flat last year, and it's down about 3, almost 4% this year. So the stock price hasn't gone anywhere in 13 months now. They're trading at a slight discount to the S&P, compared with being a slight premium over the years. Again, the risks are that Medicare Advantage pricing issue lingers on. Probably the other risk is, managed healthcare can always be a sort of a political football. If there's any sort of major initiatives towards a one-payer system like we've heard before, anything like that, that could cause some volatility in the shares. But overall, I think they're a much more diversified company today than they were, in 2008 when we went through that economic downturn, when all those people, of course, were thrown off their insurance through layoffs. So I really like UNH as a potential core holding. We just started adding to it over the course of the last few weeks in a number of our portfolios, admittedly maybe a bit early, but maybe take advantage of this weakness. If you think it's right for your particular situation, I will leave that up to you. I know what we're doing for our clients here. And as I mentioned, I own it personally in my own portfolio. So take a look at those, see if they make sense. Of course, we'll have other and more and deeper company-specific conversations as we get more earnings reports here in the next few weeks. Hope that was helpful. As always, stay healthy, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.